is the DeFi Decoded podcast by 9 Point Partners. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hi, I'm Alex Tapscott, and welcome back to another episode of the DeFi Decoded podcast here with our co-host, Andrew Young. Today, we have a very special guest, Sasha Ivanov, who is the founder of Waves blockchain. Waves is one of the sort of original layer one smart contracting platforms and has recently been in the news because of its algorithmic stablecoin, a topic that has been something of sort of interest to our audience over the past year and a half. I know Sasha has some interesting thoughts on that. So without further ado, Sasha, it's great to meet you. Why don't you start by just telling us a little bit about the your origin and the founding of Waves, please.
Hi, Alex. Thank you for having me. Let me introduce Waves. So Waves is, as you said, is one of the original chains we launched in 2016. It was one of the first smart contracts chains. It was launched like maybe 1 year after Ethereum, so we're quite old. It's totally different approach. So we don't have gas, for example. So it's like different setup of smart contracts. We created one of the first decentralized exchanges in 2017. It works like on Waves chain directly, so it's like a part of Waves basically. So it's not like L2 application; it's a part of Waves core. So we've been there for quite a bit of time, and as a lot of projects, we launched stablecoins. Our core team, I was involved with stablecoin development. I can't say that it was very successful, actually, because we did not fail as Luna, but we did have some issues. And currently, we have a lot of experience with stablecoins. And actually, I think there's going to be another attempt, like by me personally. So because I'm like still very interested in creating something stable, and I can see a lot of like attack vectors that we can avoid in future. I have a lot of experience. So it's very interesting. I think it's very important. And algorithmic stablecoins are going to stay there despite all the problems because they are very important, I think. So you can't have only like backed coins such as Tether or USDC because it's not really like crypto. It's more or less like digital money, so it's something different. So people will keep trying to create algorithmic stablecoins, and eventually someone will succeed to create something that can't be broken.
Mm-hmm. Yeah, and it's obviously been 2022 was a very rough year for algorithmic stablecoins. Obviously, it sort of started off with the collapse of Terra USD, and also saw sort of a domino effect with things like Magic Internet Money, the Tron stablecoin, and then of course USDN, which sort of previously was the stablecoin of Waves. And I think as of today, the USDN is down to about 32 cents. And I know we'll touch on, because you put out like a resolution plan on how you want to transition USDN, which I thought was very interesting. But just taking a step back, what do you think sort of caused this domino effect? Because USDN is a little bit different than UST, but it seems like all the different stablecoins all underwent a stress test at the same time. And obviously there was the market conditions is one thing, but I'm just kind of curious, how would you look back at the last year and how would you describe sort of what happened?
Yeah, basically, it's a very good question. And the answer is pretty simple. All those coins, including Luna. Luna was a bit extreme, I think, in its setup, but USDN is different, but kind of similar. So they were all like incentive based, So there was some incentive for arbitrageurs to bring the coin back to peg. And those incentives were meant to work like only under like normal conditions, So it's like they work like 99.9% of the time. But when you have some like black swan events or some kind of attacks, like coordinated attacks, they just don't work. And people don't understand that you can't build those models, those systems based on incentives, because incentives fail sometimes. And when they fail completely, so your coin gets depegged and it's very hard to return to peg because you can't predict those black swan events actually. And actually, it's not that I'm like trying to say that there was no issues, because I think if you fail during black swan events, you have some problem in your setup, even during like normal conditions, so this is a problem, but you can't see this. You need to have some black swans to basically show you that you have some errors in your setup, and this is what happened. So I think it's pretty philosophical question, why those systems fail, but the reply is pretty simple, because they're like incentive based, and people don't think about all possible conditions, and they try to create incentives for like normal conditions, but sometimes you have black swans and they break your system. So I think that a proper setup for algorithmic stable coins is closer to probably the original stable coin, which is DAI, when you have some kind of like over collateralization mechanics. And when collateral goes down, stable coins are just liquidated. And it's a better mechanics. You can improve on it, you can make it better, but probably this is the only thing that can work in the long run currently. So people haven't come up with anything better. And probably this is the way to go actually. So you don't have to create those like incentive-based coins. You have to create something closer to DAI, maybe like improve on it. And I think we'll see a lot of attempts to create something better than DAI and try to compete for the market share.
Yeah, I think just for the benefit of our audience, to distinguish between different kinds of stablecoins. So you mentioned at the outset that there are the ones that are backed by fiat, and then those are essentially issued by institutions, whether they're American domiciled companies like Circle or Tether, which is offshore. But fundamentally, the idea is like you have $1 of stablecoin, it's backed by $1 of reserves. And then there's things like DAI, which are also collateralized, but they're not collateralized in the traditional sense, like by fiat denominated assets, or at least not exclusively, because DAI actually does now include some fiat denominated assets as collateral. But basically, the idea there is like, because the collateral is volatile, the stablecoin at all times has to be over collateralized, essentially. So that if there's $1 of DAI, there may be, I think it's a 60% bump or something, like $1.6 worth of crypto assets. And then with algorithmic stablecoins, the idea basically is that you can create a crypto asset that holds its value relative to some other asset like the dollar, but it's under collateralized effectively. I mean, that's I think the distinction that people make between like a DAI and a UST or some of these others is that you can have some kind of mechanism to hold a peg, even if at any point in time it's under collateralized. Now, that might sound like some kind of like dark arts or magic or whatever, but that is actually how like the banking industry works. For every dollar of loans outstanding, a bank might have 10 cents of capital held as reserves. It is taking on leverage in that respect. But Andrew and I have talked about this a lot last year during UST. Basically, like the idea is like, how do you prevent a bank run essentially on a stable coin that by definition doesn't have enough dollars to meet demand if everybody wants to redeem, so to speak, at the same time, right? Like I think that is the central question. And so far, it seems as if every attempt, honest attempt at trying to figure this problem out has not worked. So I'm just wondering, like, how do you think of the solution, if there is any, to that? Or are we looking at basically some kind of DAI-like thing where, you have the collateral every time you need to like liquidate a coin, basically?
Yeah. So basically, yeah. So if you are trying to create a hard-pegged stable coin, which is like linked to $1, like in a very rigid way. So you commit to keeping the peg, so your stablecoin has to be $1 at all times. I think incentives setups won't work, so you have to come up with something closer to DAI. If you want to create something like soft pegged, so you don't have to have this like $1 connection at all times. It can be like more flexible. It can be like 90 cents. It can be $1.10. Probably you could create something working with incentives. So those mechanics that were actually working in Luna for a while in USDN, that are working in, for example, in Frax right now, in some other coins, they can be used, but not for those like product that claim to be linked to $1 at all times. So if you want to create something which has to be $1, probably the only way to do that is something like DAI, and also currently, because we have been thinking about that like for years, basically, especially during the last year, because it was really, tough. And we try to come up with very different setups, but it's really hard. Probably the only thing that could work here is overall collateralization and liquidation. Basically, when the collateral goes down, there has to be incentives for the arbitrageurs to basically liquidate the stablecoin. Otherwise, you can actually end up as Luna or as USDN, because it kind of failed, and I admit to that it kind of failed. So we are trying to phase it out to turn it into something else, but it failed as a hard pegged stablecoin. So currently, I can repeat that the only way to create a hard pegged stablecoin, which is a stablecoin connected to $1, is something closer to the initial DAI setup, in my opinion.
Interesting.
So what, and talking a little bit about that transition. So I was reading the Waves blog, the Waves blog post about how sort of the intention to transition USDN to a Waves sort of ecosystem equity index token, WIXT, I believe. So it's kind of an interesting way. You're trying to essentially convert. It's almost like, it kind of reminds me of like the debt tokens from Bitfinex and things in the past. Like sort of transitioning it away from like a claim on a sort of, like you said, failed stablecoin into a potential sort of like equity-like token. So that actually makes quite a bit of sense to me as like a transition plan. But what is WIXT going to look like specifically? Because I also saw that there's some interesting dynamics built into it, where essentially if the token goes up above a certain level, I believe some of the tokens get bought back and burnt. I didn't totally understand that. So what is the WIXT token?
Yeah, basically it's like a multi-asset soft peg stablecoin. You can issue it with different assets. There's a governance process. People can choose which assets can be used for collateral in the treasury. There is some incentive to issue the coin, and because there is some discount for issuance, the amount of issued stable coins is controlled by a governance token. There is a governance token in the protocol, so you can't issue and redeem like a limited amount. And there is some incentives for issuance. And also, if the price goes up, there is some incentive, like arbitrage incentive, to liquidate the coin. So basically, it's pretty simple. It's a very simple setup. I think only simple setups work here, and it won't work as a hard pegged coin. But we are not like trying to create a hard pegged solution here. So it's going to be more of an index. Has to be like flexible, and we need to basically make people whole, because there is a lot of holders of USDN, so we just can't erase it and forget about it. So we have to make sure that people redeem it and don't actually lose money. So this is what we are trying to do, and until we have resolved that, we won't launch anything else. Because we do have a plan to launch a new coin, and I can see actually a very interesting setup which is closer to DAI, but not DAI exactly. So there is a way to create some kind of like pools for issuance. There is not one issuer, there's no vaults, there is just some kind of like pool mechanic, and people just like pool their funds and issue a coin which can be actually liquidated the way DAI is liquidated. So I think it's going to be very safe and kind of interesting, you know, because it tries to combine what we had in Neutrino in USDN and the setup that has been working in DAI and which is actually successful. So this is a plan. Yeah, and meanwhile, what we are trying to do, we're trying to like collateralize USDN treasury with other tokens to allow people to exit their like positions to liquidate USDN and like basically make people whole. This is what we are trying to do. So it's quite hard because we had a crazy bear market last year, and USDN had waves and collateral, and I actually couldn't expect that it would be so bad. So and basically like we couldn't maintain the peg because it was impossible, because we just didn't have the money to do that. But still, we have to basically make people whole, and that's why we are proposing different setups. And I think this setup is interesting, and I believe it will work. It does depend on how things move forward in future, in waves, and also like in crypto in general. But if we don't see any like collapses that we saw last year, I think everything's going to be fine.
And then just one last question on the Waves specific, because there's a lot of people in the Waves community that are sort of upset and worried because I believe the USDC and USDT withdrawals right now are disabled. I believe on Twitter you said end of January they should be re-enabled for the bridge back to Ethereum. I'm just curious if you have any update there.
Yeah, sure. They're not like they're being processed in slow mode because so what happened to us and to a lot of like exchanges. So we have like a decentralized exchange I mentioned at the beginning that was launched like 5 years ago. But the bridges, it has bridges, gateways, and they're like centralized. And we had a huge bank run during last year. So I think around $500 million were withdrawn basically from the gateways. So, and there is like basically it was a huge bank run now. So, and we can see some inconsistencies now, and we are checking everything, and it's not critical. It's the amounts that are kind of like questionable are really small, but we are still trying to make sure that there is no hacks, and we actually are moving on to the new bridges currently. So there's going to be a transparent, decentralized bridges, and I think they're going to be launched at the beginning of February, and like the normal operation will be resumed. Until then, yes, so there's going to be some glitches, and withdrawals can take time. It's kind of bad, it's a bad moment for Waves, but like it's going to be better, so because actually, I don't know if you followed, maybe you didn't, because we have been struggling since probably since last March. Basically, we have some kind of like situation with Alameda and some kind of fraud campaigns, and we are still struggling. Yeah, but it's getting better, and I think the resolution is pretty close.
Yeah. Just a question about the new design. So if it's going to be more DAI-like, do you think about the potential scalability of that kind of a platform, like that kind of a stablecoin? Because one of the things that was really interesting about UST is that it, in a matter of like 18 months, it did become, it had a market value of like $30 billion or something like that. So it far exceeded the growth of DAI. Now, maybe it was living on borrowed time and it was doomed to fail regardless. But it seems as if it was the only non-centralized stablecoin that was able to get to the same kind of scale as a centralized stablecoin. DAI has been around since 2017, and it's, I don't know where it's at. It's like $7 billion or $6 billion, but it's been steady Eddie, and it's fine and everything. But it's never been able to like break on through to the scale of some of these faster growing centralized ones. Like just thinking about like scaling this, do you think that non-centralized, like decentralized, stable pegged assets can be as big and impactful as centralized ones?
Sure, they can,
because you're designed as well, right? Sorry, that's that question.
The DAI is not perfect actually, because there is no incentives to issue DAI. If you look closely, so there is some incentives, but it's not for everyone. So if you they're like external, you need to issue DAI if you want to like put it into some pool, for example. So for like regular people, there is no incentives to issue DAI. And we definitely can improve on that. As you could see with Luna, actually, it can be successful. Luna was a bit extreme, in setup, because it had a very like weird setup, in my opinion, because there were no controls, no like checks and balances, as with Luna. But you could see that it was an interesting product for retail. And I think that if we are able to improve on the DAI mechanics and create some incentives for issuance, for example, for this like new coin, because there has to be some incentives for people to issue it, for like regular people, and to hold it as well. So it can be successful as a retail product, because those like backed coins, they're successful, but they're like their use case is trading, basically, because you need to trade against something. People traded against Bitcoin initially, but it wasn't like, it was kind of like very weird, because Bitcoin is volatile and people still trade against Bitcoin. But obviously you need to trade against dollar. So the only use case of USDC and USDT is mostly like trading, and there's of course some like settlements, international settlements, and pay people for different things on the internet with USDT. But the real use case is trading. So probably if you can come up with some other use case. So it's not a question of like being backed or being algorithmic. I think the problem is use case. So if we want to create a very successful algorithmic stablecoin, it has to have some use case, So in case of Luna, it was like APY, because they paid basically out of treasury 20% APY, which can't be sustainable, obviously.
No.
So there can be some other approaches, for example, so probably you can create some kind of like, okay, you can maybe enhance on the idea of Tether, basically what Tether did. And I don't think it's a secret, so basically you could see that during like bull runs, they issued a lot of Tether, and probably they were buying Bitcoin. So there is a lot of Bitcoin in their treasury, obviously, so you could create something similar with algorithmic coin, when basically algorithmic coin is used to, for example, buy crypto, so there is some kind of like governance process. There is a DAO that decides to issue an algorithmic stablecoin, basically, and use it to buy Bitcoin, for example, and then share the profits. So there can be some use case which is different from trading, for example, investment use case or staking use case. And if it really makes sense in terms of like APY or potential profits, I think it can be successful as a retail product. And I think Luna proved this. It failed, but you could see that the traction was huge.
Yeah, definitely. Andrew, do you have any other questions?
Yeah, I think I'm still trying to figure out. So how to can you describe a little bit, because Waves is sort of unique in having multiple different tokens. There's sort of the Waves token. There is the USDN, which has now become WIXT. I believe there's also a Surf token as well. How do yeah, do you want to just kind of explain like the dynamics between all the, because I think this is the first time I've seen like a tri token setup. And so I'm trying to understand like how all these different tokens sort of work together.
Yeah, it's kind of like it's not a very beautiful story actually, because we have been struggling last year. So basically, there was like USDN, and it was launched. So there, like a little back history. Basically, I think I launched this around 2019 USDN, and I didn't think that it would be like so, complicated. It was launched before Luna, actually. The setup is similar, but it was launched before, or approximately at the same time. And I didn't know about Luna until last year. And I think we were like inspired by the same approach. There was a project which was called Basis, I guess. It was unlaunched. It wasn't launched. It was a project from 2017, and they came up with this like incentive-based setup for repegging. And I think Doc One read the same article, basically, so, and it was like an old project, and actually it didn't get a lot of traction. So I didn't think that anything that happened to USDN could happen, basically. And there was like a governance token which was called NSBT, and this still exists, neutrino system basic token, basis token, and it was a governance token. And we had to launch another token, SURF, which was meant to recapitalize the treasury, because a lot of funds were drained from the treasury last year because of a bear market. Waves price fell, and backing ratio fell, collateralization level fell. So we tried to create some incentives for people to recapitalize the treasury by issuing a new token that they could redeem at $1 if the treasury became recapitalized again. But it failed as well, so, but the token still exists. And if actually the collateralization level is back to 1 again, they will be able to redeem it to $1. And there is some other utility to it. So that's how it came about. So we just tried to resolve this issue in different ways. We didn't succeed, but we are still fighting.
Yeah, and I want to be conscious of our time, because I know we don't have too much more time, but I have one. I would love to hear at least your side of the story with Alameda. I know you sort of hinted towards it, just for our audience who sort of may not be aware and doesn't follow crypto Twitter at the same level.
I can like maybe. So I'm not really gonna try to pin the blame on Alameda or something. They try to short Waves. Obviously, also they probably pumped. I can prove that, but there was some like tweet of mine with a description of this, and basically they got stuck in our lending protocol, and we were negotiating with them when this whole debacle happened with them. So basically, we have some like funds in USDN from Alameda. I think it's around 100 million, still stuck. So it's like it's all public information. So I'm not like saying anything which hasn't been revealed before. So there was like I don't know. I mean, it's really hard to say, because this situation was like kind of a surprise for me. I don't know where it actually came from, because some people try to manipulate Waves, so they pumped it. At the same time, there was a lot of like USDN issued, and then there was a huge like campaign to basically bring the Waves price down, and people succeeded. So okay, good for them. And probably there was some Alameda involvement as well, maybe not like from Sam directly, maybe some of his like guys, I don't know. So, but what we have now, there is some funds from Alameda stuck in our lending protocol, around 80 million, I guess, as far as I can remember. Yes, and basically we announced that we will be able to basically transfer those funds. We will transfer those funds to the liquidator if there's some kind of like bankruptcy liquidator or trustee. We will transfer those funds to them to help them resolve the issue with like lost funds on FTX.
Got it. So yeah, and I read your blog post. Essentially, you were saying that it was your belief, at least at the time, that Alameda took out huge loans through sort of the Vyers finance, which is I believe, a lending product.
Yeah, they
Waves.
basically did. Yeah, they admit to that, no problem. So maybe they try to short or they try to collect the interest. That was also possible actually, because some people think that they didn't try to short, they just collected funding rate. So hard to prove that, and basically it's impossible to prove anything. So I'm not trying to, because you need to look much deeper. Can you hear me? Sorry.
Now we can. Yep.
Yeah.
You said it's impossible to prove, and you have to dig much deeper.
Yes, it's possible. Yeah, it's impossible to prove anything here. Yeah, it's possible definitely, but you need to do some like investigation. And I don't care that much about that, because I have other things to do.
Yeah, right. Well, that's a really helpful update, Sasha. We appreciate it. As I said at the outset, there's been a lot of interest in algorithmic stablecoins since the collapse of UST. It's not easy coming on and talking about it after your own project suffers the kind of impact that you did. So we appreciate that. And your candor and your honesty. And I don't know what the future holds. I hope that your next kick at the can here is successful. And we really appreciate it once again. So thank you for joining us. And
thank you for having me.
Yeah,
bye.
Absolutely. All right, thanks. That concludes today's episode of DeFi Decoded. We will see everybody next week. Until then, that's it. See you later. Take care. Bye.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.